What if I told you that a company could shatter every single financial record on the books, post a growth score that analysts are literally calling unprecedented in the history of software, and still watch its stock get cut in half from its all-time high? Welcome back to Smart Stock Sam, the channel where we cut through the Wall Street noise and hand you the real story. And today we are going deep on Palantir Technologies, ticker PLTR. Here's what's wild. This company is being called the Messi of AI in the defense world, the undisputed GOAT of its field. And yet the so-called smart money on Wall Street is running for the exits at the fastest pace in a decade. Why? How does a company with explosive fundamentals see its stock crater over 20% in just a few months? And here's the question that should keep you up at night. What if the smart money is actually the dumb money on this one? Stick with me, because in this video, we're going to walk through the core paradox at the heart of Palantir, the ownership shakeup that's spooking retail investors, the government anchor that could hold this company steady for the next half-decade, the one hidden valuation metric that flips the entire "is this stock expensive" narrative completely on its head, and the exact price targets and entry levels you need on your radar right now heading into next week. By the end of this, you will know whether PLTR is a falling knife or a generational buying opportunity sitting right in front of you. Let's get into it. Right now, Palantir is living in two completely different worlds simultaneously. In the world of actual business operations, they just reported a 70% revenue surge in Q4 2025. 70%. Let that number sink in for a second. But even more jaw-dropping is their Rule of 40 score, which just came in at 127%. Now, if you're not deep in the SaaS investing world, here's what that means. The Rule of 40 is essentially a health check for software companies. You add your revenue growth rate to your profit margin, and anything above 40% is considered elite, best in class, the cream of the crop. A score of 127% is so far off the charts that analysts are struggling to find historical comparisons. So then why is the stock down between 17 and 22% year to date? Well, this isn't necessarily a Palantir problem. This is a macro problem. We're dealing with a cooling software sector, institutional de-risking, and heightened geopolitical tensions that are pushing investors towards safety. The market is throwing the baby out with the bathwater, and that, my friends, is exactly where opportunity lives. As of our latest data from April 2nd, Palantir is trading at $148.46. Now, context matters here. The 52-week range on this stock is a staggering spread between $66 at the bottom and $207 at the top. We are currently sitting much closer to the top of that range than the bottom, with a market cap hovering around $355 billion. But here's where the momentum story starts getting interesting. The previous quarter was an absolute bloodbath. The stock dropped over 24%. Yet the past month has shown real, tangible signs of life. We've seen a 6.6% recovery, and in the last trading session alone, it edged up 1.34%. Could this be the beginning of the stabilization phase before the next leg up, or is this just a dead cat bounce before another wave of selling? Well, don't change the channel, because the ownership data is about to reveal something that will completely change how you see this setup. Here's the part that should stop every retail investor cold. If the fundamentals are this good, why is the so-called smart money sprinting for the exits? In March alone, hedge funds offloaded equities at their fastest pace in 10 years, and tech was their primary hunting ground. And then there's the insider activity. Over the last 3 months, insiders have sold $140 million and 54 cents worth of stock. Peter Thiel himself divested around 2 million shares in March. CEO Alex Karp is selling under a planned trading schedule. Now, to be fair, planned sales are often routine, designed months in advance, and don't necessarily signal anything sinister. But the sheer volume at these levels, it's rattling retail sentiment. So the question becomes, Is this the sharks swimming away from a sinking ship, or are they simply booking profits after an absolutely legendary run while the long-term thesis remains completely intact? Here's what I think is the real anchor keeping this $355 billion ship from going under. The United States government. That's the anchor. Palantir's Project Maven, their AI battlefield intelligence system, has officially transitioned from a pilot program to a program of record. Now, if you don't know what that means in government contracting terms, let me tell you, this is massive. A program of record means the funding is now a permanent, budget-backed fixture across all military branches. This isn't a trial anymore. This is infrastructure. Factor in a $901 billion U.S. military budget for 2026, plus supplemental funding tied to ongoing geopolitical conflicts, and Palantir isn't just positioned in the defense sector. They are woven into the very fabric of American national security, but it doesn't stop at the Pentagon. The IRS is now actively testing Palantir's Snap tool to modernize its entire data infrastructure and hunt down high-value tax fraud. This deepens a government relationship that's already worth over $200 million. Could Palantir eventually become the operating system of the entire United States federal government? I'll let you sit with that thought for a moment. But here's the thing. If Palantir wants to become a trillion-dollar company, they cannot live on government contracts alone. They have to win in the enterprise boardroom, and the evidence suggests they are doing exactly that. They just signed a massive 5-year renewal with Stellantis that runs all the way through 2031. This isn't a software pilot or a proof-of-concept experiment. They are embedding Foundry and AIP directly into global manufacturing operations at one of the world's largest automakers. That's not a customer, that's a partner. On top of that, their alliance with Bain and Company is acting as a force multiplier, putting Palantir's platform directly in front of the world's most powerful CEOs through elite consulting channels. Think about what that distribution engine actually means for their commercial pipeline over the next 3 years. When you combine Project Maven, the IRS relationship, the Stellantis deal, and the Bain partnership, you get something extremely rare in the technology world: unprecedented revenue visibility. Palantir has effectively locked in its foundational revenue streams through 2030. While the stock price bounces around on daily macro headlines and sector rotation noise, the underlying business has structurally insulated itself for the next half-decade. They have built a financial fortress around their cash flow. And here's a question worth asking. What happens to the valuation of a company that has this level of revenue certainty when interest rates eventually normalize and growth stocks come back in vogue? Could Palantir's revenue fortress make it completely immune to the next market downturn? Let's look at what the charts are actually telling us right now. If you're a technical trader, the current setup is quietly constructive. The 14-day RSI is sitting at 58.4, comfortably in buy territory, recovering from neutral without being anywhere close to overbought. The MACD is at 0.11, which is a supportive signal, and the stock is currently trading just above its 5-day, 20-day, and 50-day moving averages. What this tells us is that we are in a period of bullish consolidation. The market is catching its breath after a brutal sell-off, and the Fibonacci pivot point is sitting right at $147.48. The technical structure here isn't screaming run for the hills, it's whispering patience. Now let's go into the underworld of the market, options and short interest, because this is where real conviction lives. The short interest is currently 52.6 million shares, which is only 2.38% of the float. With a days to cover of 1.66, the probability of a massive short squeeze igniting this thing? Minimal. Don't count on that being your catalyst. But the options market is telling a fascinating split personality story. Active short-term traders are bullish, reflected in a put-to-call volume ratio of 0.64. However, the long-term option holders are considerably more cautious, with a total open interest ratio of 1.10. Also, and this is critical heading into the week, keep a very close eye on the max pain window sitting at $147 for the April 10th expiration. Prices have a well-documented habit of gravitating toward that magnet as expiration Friday approaches. Watch that level closely. Okay, here's where most people get Palantir completely wrong, and it is the single most important part of this entire analysis. On the surface, the traditional valuation metrics look absolutely terrifying. We're talking 78 to 82 times trailing sales, a forward PE of 104 to 115 times earnings. By old-school standards, this is one of the most expensive stocks in the entire S&P 500. Full stop. But, and this is a massive but, when you account for Palantir's earnings growth rate of 228.6%, you arrive at a PEG ratio of 0.96. For those unfamiliar, a PEG ratio under 1.0 generally suggests a company is technically undervalued relative to its growth trajectory. You are paying a premium, yes, but you are buying into extraordinary earnings acceleration. The question isn't whether the stock is expensive. The question is whether the growth justifies that price. And at a PEG under 1? The math says it might. But here's the catch. To keep that PEG ratio healthy, Palantir must execute flawlessly on 3 specific benchmarks. If you own this stock, write these down. First, U.S. commercial growth must maintain over 100% year-over-year expansion. Second, contract realization. We need to see that $10 billion Army enterprise agreement translate into actual realized revenue, not just headlines. Third, operating leverage. Can they sustain that 57% adjusted operating margin as they scale? If any of these 3 falter, the entire valuation argument collapses. This is a high-wire act, and the net is far below. So where does Wall Street actually see this going? The median consensus price target sits at $200, which from current levels represents a 36% return. Not bad. But the bull case from top firms like Wedbush and Citi sees Palantir hitting $230 to $260. That's a potential 75% upside from where we sit today. Now, could the bears be right? Could slowing growth send this back to double digits? Of course it could. But for the bull case to materialize, and I believe it can, execution has to be immaculate. Here is your disciplined price ladder for entering this trade intelligently. The recommended entry zone sits between $143 and $146, right where the 20-day and 50-day moving averages are converging and creating a natural support floor. Below that, your hard support level is at $140.51. To the upside, your first major hurdle is the psychological barrier at $150, and beyond that, the longer-term moving average benchmark sits at $164. For risk management, and this is non-negotiable, your stop loss should be executed below $136.30. That level protects you if sector rotation gets significantly uglier. Our final rating is a strong buy, but let me be precise. This is a disciplined buy. The fundamentals are indisputably extraordinary. The government contracts are real and permanent. The commercial partnerships are long-term and deepening. But the valuation demands flawless execution, and the smart money is still circling, waiting for cleaner entry points during this consolidation phase. For patient, long-term investors who understand what they own, the story through 2030 is incredibly compelling. Mark your calendars right now. May 4th, 2026. That is the Q1 earnings report, and it is the moment of truth for everything we discussed today. U.S. commercial growth, operating margins, contract realization, all of it goes under the microscope on that single day. If Palantir beats expectations there, those $200 price targets could arrive much sooner than Wall Street currently anticipates. Now, before we close out, and I need you to hear this clearly, nothing in this video is financial advice. This content is for educational and entertainment purposes only. Always do your own research, and please consult a licensed financial advisor before making any investment decisions. Every investor's situation is unique, and past performance never guarantees future results. Now here's my question for you, and I genuinely want to hear what you think. Is it the best time to buy it, or will it go down if market corrects further? Drop your answer in the comments right now. I read every single one. If this breakdown gave you value, smash that like button. It truly helps this channel more than you know. Share this with anyone in your circle who's watching PLTR right now. And if you haven't subscribed yet, what are you waiting for? Hit that subscribe button and the bell so you never miss our next deep dive. This is Smart Stock Sam. Stay disciplined, stay curious, and I'll see you in the next one.